The structural state of the economy is not good. It's an impossible fix. It's an impossible fix. And our primary thesis that we are in a debt-based collapse continues to assert. And the key element that comes out of this is invariably that the probable only safe haven during this period is a combination of cash in hand, getting it out of the banks, and in gold. Part and parcel because money has been rotating out of the debt system, the bond market, the US treasuries, which has been the driver of those rates. That's why you're getting to extended valuations.
The debt crisis is upon us, reshaping the financial landscape. Banks are concealing massive losses, housing affordability is plummeting, and trust in the US economy is rapidly eroding. Francis Hunt warns that the debt-based system is unsustainable, and he believes gold may be the ultimate haven amid this growing financial storm. He stresses that, in such turbulent times, the best strategy for protecting wealth is holding cash outside of banks and investing in gold, as these assets provide security in a world of mounting economic instability. The U.S. national debt has now surpassed $36 trillion, a staggering increase less than 4 months after crossing the $35 trillion threshold. On Friday, the Treasury Department issued a stark reminder of the consequences of inaction. If the debt were divided equally, each American, regardless of age, would be burdened with over $106,600 in debt, while taxpayers alone would owe more than $272,800. The federal debt-to-GDP ratio has surged to 122.85%, a significant rise from 55.36% in 2000 and 34.71% in 1980, highlighting the growing financial strain. On the other hand, the World Gold Council's Q3 2024 Gold Demand Trends Report reveals a historic milestone for the global gold market, with total demand reaching over $100 billion for the first time. Central banks also maintained their appetite for gold, with purchases totaling 186 tons in Q3. Though slightly lower than previous quarters, year-to-date demand from central banks reached 694 tons, in line with the same period in 2022. Underscoring their continued reliance on gold as a secure reserve asset. Hunt further notes that recent Federal Reserve actions, such as interest rate cuts, have led to a rotation of money out of the debt system and into gold. This shift is being driven by a lack of liquidity in the bond market and a desire for safer investments. Understanding this dynamic, central bankers have increasingly turned to gold as the ultimate reserve asset. We're about to explore the video, but first make sure to subscribe and hit the bell icon to keep up with our newest uploads. Your feedback in the comments is always appreciated.
The structural state of the economy is not good. It's an impossible fix. It's an impossible fix. And our primary thesis that we are in a debt-based collapse continues to assert. And the key element that comes out of this is invariably that the probable only safe haven during this period is a combination of cash in hand, getting it out of the banks, and in gold. Actually, the US is an exchanger for countries that manufacture things, take in raw base materials and produce a finished line item. And they return to those nations that give them manufactured items with all the margins that is earned and the value add accruing to that company that is exporting to the US. We return, or the United States returns, a debt instrument based in dollars. In other words, they are encouraged to circulate the payment into an investment in debt instruments and hold dollars. And less popularly now are the exporter nations willing to do that, particularly if you're China and certainly not Russia, after the appropriation of Russia's funds. So what's typically happened is the dollars are requested and those funds are going into gold. I'm going to make the case that we've actually been in a lengthy recession, which has been particularly hard on the consumer. Yet in that environment, gold has been going up in a recession. Plus in an environment where the rates have actually been going up, which is, of course, the devaluation of the debt. Rates up, debt valuation down. And that rather than what's typical, rates up environment being bad for gold, this is a different kind of decline in the value of debt. This is the loss of confidence in a fiat debt based system that sees gold as the alternative asset, the reserve asset for seeing through a tricky period, and that the greater the interest rate goes up, which is the contraction or in the value of debt, the more money is flowing into gold. So actually you have gold going up in value in an increasing interest rate environment. Of course, we just recently had 2 basis points cuts by the Fed. Part and parcel because money has been rotating out of the debt system, the bond market, the US treasuries, which has been the driver of those rates. That's why you're getting to extended valuations. There's liquidity looking for a home, and it's flushed out of the bond market and it's gone into the equity market. And more importantly, the central bankers who see and understand this game have gone straight to the reserve asset, that is gold. And actually we traded 1984, ominous number in February, and today we're well above the 2,750s level.
Gold demand from the technology sector saw a 7% year-on-year increase, driven primarily by the electronics industry's growing reliance on gold for high-performance applications, especially with the advancement of artificial intelligence. In response to this demand, total gold supply rose by 5% year-on-year, fueled by a 6% increase in mine production and an 11% rise in recycling. This uptick in supply was crucial in meeting the expanding global demand for gold across various industries. Hunt forecasts substantial downside risks across various markets, including equities, housing, personal credit, and municipal debt. He believes that, in this climate of economic instability, gold is emerging as an increasingly appealing asset, offering a safe haven for investors. Hunt asserts that the inherent strength of gold will allow it to withstand economic turmoil, positioning it as a dependable investment during these uncertain times. Now, let's redirect our attention to a video.
The current unrealized losses held by the banks, notice how much worse this is than 2008, says the poster. If the yield curve rises instead of falling, which it is currently doing, this collateral situation gets significantly worse. And this is showing you banks, of which Bank of America is one, and we know Warren Buffett has been selling out entirely out of Bank of America, and in fact out of most banks, unrealized gains on investment securities. So banks were encouraged to buy the government debt at probably one of the worst times at one of the lowest interest rates. Since that raising cycle from near zero all the way up to Powell's peak before this 2 cuts, the losses on those debts unrealized are far higher than anything that existed in 2008. And I've shown this chart a couple of times before. This is huge. And as I say, our forecast is the ability to reduce rates it's significantly less than it's been in previous cycles. There is no bid. The bifurcation of the supply chain, the problems with the BRICS, the aggressive tone with China and Russia has led to America losing support for its petrodollar support and its trade support of having exporter nations happy to carry treasuries and dollars. They see no way back for the debt market. They do not wish to hold it as an asset, and they are chasing gold. Gold is going up. You know I'm going to say that, and you know you're in the right place and the right hand. So let's have a little look at the gold chart after all of this. So our prediction is essentially for a lot of downside risks in the market, both equity, property, personal credit, state and municipal credit, it has to be highlighted, that are bankrupt, and national that are bankrupt. And in fact, there's a couple of other charts I wish I'd put together, but actually America is the worst on interest paid on debt. Worse than Japan, worse than all the nations you're told that are supposedly worse. America is the highest in terms of contribution to payments on interest. It is the single largest as a percentage of GDP. This particular one, while it's very hard on childcare, is showing since the shadow stats era of 1982 how inflation has gone up. And you can see that it is food is up, housing is up, childcare is a big runner here. That's this particular theme over here. But all of these are up 350, 300, 268%. And of course, childcare, which is part of the theme, is nearly 900%, which is huge. But that is how much housing, food, transportation has gone up since those eras. And can I tell you, you know what gold was way back then. It's actually well behind where it can and probably will end up being. So without further ado, let's take you to the gold charts. Bankers admitting that they've over borrowed is not typically something they do. They leave you and I and tell us we overconsumed. It's always our fault, actually. They never accept policy mistakes. The events of March 2020. In actual fact, it's quite possible for a short spell that gold could dip on any frightening event. And I think we've got a bank failure as a possible event. We've got a related currency volatility on any possible event. We could have repo markets. There's so many possibilities. It's impossible for me to explore all of them. I'm not trying to be right. I'm saying something's going to break. The rivets on the submarine under this level of pressure are absolutely popping out of the steel plates. But the key thing is the one asset that will shrug off any downward based demand destroying event will be gold.
Gold has long been viewed as a safe haven and store of value in times of uncertainty, and the events of 2024 have once again solidified this reputation. The remarkable performance of the precious metal this year can be largely attributed to ongoing geopolitical crises. While Trump's election win introduced short-term volatility, gold has flourished amid escalating global tensions, rising inflation, Federal Reserve rate cuts, and central bank buying. Goldman Sachs predicts a rise to approximately $2,700 by early 2025, while JP Morgan forecasts a value of $2,500 by late 2024. What are your thoughts on holding gold as part of a diversified portfolio in uncertain times? Share your feedback in the comments below. If you found this video useful, hit the thumbs up and subscribe to keep up with our latest updates. We appreciate you being a part of this journey.